When you start to invest and begin to learn about the options available to you, you will hear the words risk and return a lot. In part 2, we learned that a return is defined as the income an investor receives from an investment every year. So, what is risk in relation to investing? Risk is defined as any uncertainty as regards your investment that has potential to negatively impact your overall wealth. Investments are always impacted by the rise and fall of market conditions. But don't panic. There are always ways to minimise risk. When it comes to investing, the greater the risk, the greater the potential return on your investment. And consequently, the lower the risk, the lower the return. So, before you start investing, you need to know what your risk appetite is. The answer to that all depends on you, your goals, your age, income, and investment expertise. Within the industry, we talk about investors with a high risk tolerance, moderate risk tolerance, or a low risk tolerance, as a way to match potential investments with investors. But keep in mind that your risk profile may change as you move through the various stages of life. An investor with a higher risk tolerance profile is usually a person who has a lot of investing experience and a great understanding of the markets. The more experience an investor has, the more composure they are likely to have during periods of market volatility. A moderate risk investor is comfortable with some justified risk. They put in a sizable amount of money in anticipation of losing some of it, but not all. A low-risk investor is more cautious. They invest with the aim of making stable returns and minimum loss. As we've demonstrated earlier, the longer time your money is invested, the more profit you will see, especially with compound interest on your side. However, the market will go up and down, and there is no certain way to predict when. Before making any investment, you must ask yourself, is there enough time for your investment to recover before you need the funds? For example, if you're investing a lump sum this month and you're planning on using the same lump sum for a house deposit in 6 months' time, you might need to give the investment more time to recover if it happens to dip in value. Your time of life is also of crucial importance. Putting your pension in a very high-risk fund at age 50 would not be a wise move. The main rule of thumb is, don't ever invest more money than you can afford to lose. High risk can be a good thing when you've identified an amount that you can afford to lose and commit to a high-risk investment. You could potentially see big returns. But when you're just getting started in investing, some reassurance is absolutely key. Remember, investment options are like dresses. They can be tailored to fit anyone. The idea of risk and loss of money might be enough to make you nervous. But don't forget that money is still invested will always work harder for you than money in a savings account. The best thing to do is to sit down with a financial advisor who will go over all of your current financial goals in detail and work out how much risk you can really afford to take on. Let's now learn about the asset classes. First of all, what is an asset class? Asset classes are groups of similar investment products which are subject to similar rules and regulations. There are 5 main asset classes. These are cash, property, bonds, stocks, and alternatives. Cash is money on deposit, and property is physical bricks and mortar or real estate investment trusts, or REITs. You might not be as familiar with bonds, equities, and alternatives, so let's cover them in a bit more detail. When people invest in stocks and shares, this is called an equity investment. That's because when you buy a share, you are in effect a part owner of the company. Stocks, shares, equity, and shares of stock are terms that tend to be used interchangeably. Companies will often give up equity, which is defined as partial ownership of the business, in exchange for cash. When you hear of a company going public, they are undertaking an initial public offering, which is called an IPO for short. By selling shares and therefore part ownership to the public and thus raising additional capital for the company. When you own a stock or share in a company, you own a part of that company, whether it be big or small. Even if it's 0.02% of a share, you're still a shareholder. Therefore, the rewards you may reap are tied to the fortunes of that company. If a company's stock jumps 30%, you can look forward to an excellent gain on your investment. And vice versa. If the stock takes a big hit, your investment will also plummet. Bonds. Bonds are another way for companies or governments to raise capital. The capital amount that they're looking to raise is too large for a bank to give them, so they raise funds from bondholders. Investors are given bond certificates, or IOUs, as proof of their investment in the bond. The company or government pays an interest rate to the bondholders on a fixed schedule until the bond matures. It is because of this fixed interest rate that they earn the name fixed income. At maturity, the company pays off the borrowed amount. When it comes to the company's success, bonds work differently from stocks. A corporation could have an excellent financial quarter, but bondholders will only receive the agreed interest payment and eventually, usually after 5 years or so, the entire amount of the bond. The returns can be small but reliable and consistent, and the risk to the investor is much lower than that of the variable returns of stocks. Alternatives. An alternative investment is one that is neither stocks, nor bonds, nor cash. Alternative investments can include private equity or venture capital, hedge funds, managed futures, art, collectibles and antiques, commodities, and derivatives contracts. Cryptocurrencies also fall under this category. Alternatives are mostly held by institutional investors or high net worth individuals because of their complexity and high degree of risk. For the purposes of this course and to get you started as an investor, we will focus more on bonds and stocks and their relationship to risk in Module 2.